businesses are built by teams, not by individuals. And for us, it's important that everybody is rewarded rather than just the founders. My name's Ifty Nasir. I'm here to help you understand how to set up early stage ventures, partnerships in particular. But as we go into that, I will first give you a little bit more of an understanding of equity more generally, and certainly how it relates to early stage businesses. A quick background on Vested itself. It's a regulated platform to help startups and SMEs share equity with their teams and everybody who helps them build their business. Obviously, businesses are built by teams, not by individuals. And for us, it's important that everybody is rewarded rather than just the founders or necessarily just the people who are investing in cash. Today's teams are not all the same. There are a whole host of folk who make up today's teams, whether they're employees, contractors, consultants, even NEDs and advisors, as well, obviously, as the investors themselves. But being able to reward everybody with some skin in the game, which is what we're really here about, is often quite complicated and complex. It certainly costs a huge amount of money to get all of those different cast of characters vested in the business, unless you have a way of doing it as we do. And it's often very complicated. So again, unless you have a way of doing it that takes away that complexity, you end up leaving it for another day. So what I'll do now is just give you a quick walkthrough of the different types of equity that you'll learn about and work with as founders of businesses. And we'll split them into two sections. The first is those for which you'll deploy against cash investment. So ordinary shares, which is what you'll have set up the business with, or indeed pref shares, which when later stage investors come along. So ordinary shares you'll give amongst the founders, founding team, and early stage investors, early angels. Later on down the line, you'll have more sophisticated investors who may well want preference shares. Those preference shares give them some advantage and first call on capital generally if there's any liquidation of the business. The other tools that I've mentioned here are the non-cash investment tools. So many of you will have been familiar with options. Now, options are not all the same. There are those with tax benefits like EMI, enterprise management incentives, which are for early stage businesses, a brilliant scheme that allows founders and businesses to give early stage team members a reward that's basically going to be taxed at 10%. So if the shares today were, let's say, £1, and they go to £10, that £9, the recipient will only have to pay 90 pence tax on. It's brilliant. And the company can offset the whole of that £9 gain against corporation tax. Unapproved options, and again, if there are any questions on any of these, please drop them in, and I think Ragnar's going to pick them up later on, and we can talk them through. Unapproved those without a nice tax wrapper, and so when that same rise that we've talked about here, going from £1 to £10, that £9 growth is going to be subject to income tax at the point of exercise. So, often 40 to 45%. So there's a big difference between the different types of options that are out there. People see them all as one thing, but they're not. The other tool that's used quite commonly now is a growth share, which allows you to issue shares at whatever stage you are in the business to those people who either are not employees or from businesses that are not eligible for EMIs, and there's quite a lot. But growth shares as a structure are a really powerful tool for early stage founders, early stage teams. And the thing that I'd like to talk through with you today is a mechanism that we've talked about, Vested quite a lot, and we've got a number of clients using it, which is called an Agile partnership. To work an Agile partnership, you'll need a couple of principles and understanding of tools or equity processes to help you on this journey. So the first one we'll talk about is the growth share. So a growth share is a real share, unlike an option, which is a right to a share. A growth share is real share at the stage when it's created. So let's walk through a quick little story. So let's say there's a couple of founders. They've set up their business and they've built it up to a couple of £1 million in value. So Stephanie and Ted have built the business up. They now want to bring somebody else in along with them. That somebody is Jim. Now, what Jim will get is a share with a hurdle. So as we were talking earlier, at the point of issuance, the share has no value, and the hurdle provides for that no value. So that the hurdle will be set at the current share price, let's say it's £1, as we were doing with the other stuff, and a small premium, typically 10-20%, known as the hope premium. So when Jim gets his share, he gets none of the value that Stephanie and Ted have already created in the business. What Jim will get is his share of the growth that he helped create. And as a consequence, he will only have to pay capital gains tax on that, because when he received the growth share, it had no value. When he sells the share, let's say at the end of this stage of the journey, he would have £1.80 of growth. But then against that, he'll only have to pay capital gains tax. This sort of structure can work again and again. So let's say a year later, Sarah comes along. A new hurdle is created for Sarah, and none of the value that Jim or the founders created before Sarah turned up is shared with Sarah. But what Sarah gets is her share of the growth that she's contributed to thereafter. So a growth share allows new people to access the business. They don't get any of the history that's being created by others, but what they do get is the opportunity to share in the growth of the future from that point. So on joining the business, on receiving these shares, there is no tax liability. When they sell these shares, there is only a capital gain, which is currently, let's say, 20%. So that's the growth share principle that we need to have in mind when we're looking at an agile partnership. The other principle is having the notion of a conditional share in mind. Now, a condition can be put on an ordinary share or indeed a growth share. So let's go through another little story that has our founder, Stephanie, at the starting point again. And at this stage, she's asking Simon to help as a strategic advisor. Let's say he's a NED for a couple of years. In exchange for his contribution, he'll get 100,000 shares. When they start this relationship, either it's at the early stage of the business, where they've just been where Stephanie has just incorporated, or it's some way down the stage and it's a growth share. In either scenario, the starting point is zero value. Okay. Let's say 2 years down the road, the business has grown and the shares now have a value of £1. That's when Simon has completed his contribution to the business. Let's say he holds on to the shares for another year and then he sells them at £2, just to keep the maths easy. Now, there are a number of ways of doing this transaction. One would be for Sarah to issue the shares to Simon on day one, and then and there's no income tax because they have no value, as we said earlier. And then when Simon sells them, the capital gain on those shares at 20%, £2 a share, 100,000 shares, that's £40,000 in capital gains tax. Simon walks away with £160,000. But the risk here is to Stephanie, because if halfway through that journey of work that Simon was supposed to do, he walks away, or he leaves after completing the work, or doesn't do what he agreed, then Stephanie is exposed. Yes, she can pull those shares back. There's always a way to do that, but it's generally quite expensive and complicated to do. If value has been accrued on those shares, let's say they'd gotten up to 50 pence, for instance, then there is the tax complexity to work with as well. So this scenario, or this way of solving that issue, is not the most helpful for the founder, definitely. But you'd be amazed at how often this happens. Shares issued up front to somebody who promises a certain delivery, and then they don't actually deliver. So an alternate way for Stephanie to do this would be and this is just a very simple and absolute opposite, would be for Stephanie to issue those shares to Simon after he's completed those 2 years of work. Obviously, there's ways of vesting different amounts over time, but we'll keep it simple for the purposes of this scenario. So if Stephanie says you get the shares once you've completed, then the challenge is that when he completes that work, those shares have now got a value of £1. With a £1 value, then 100,000 shares, Simon's a high rate taxpayer, so he's going to pay £45,000 £25 up front for those shares on receipt. Now, he's not selling them at this stage. He is net out of pocket at this stage at £45,000. And remember, shares can go up as well as down, or down as well as up. So it's a precarious position for Simon. Then once another year has passed and he's ready to sell, the 100,000 shares have now added another £100,000 because we talked about the £2 sale price. So Simon's going to pay another £20 in capital gains tax. So Simon only walks away with £135,000 in this scenario, and he runs the other risk that Stephanie might move the goalposts onto that delivery. So this scenario is really tough for Simon to hold. He's putting money on the table, he's going to end up with a lower net amount, and he runs that risk. So the way that we've built a solution to this, where you minimize the risk to both sides of the equation, you maximize the benefit and maximize the flexibility as well. So in this scenario, the shares are created at the point of the handshake, and then they're held essentially in an escrow, a legal digital escrow that we've constructed until such time as the job has been completed, after which Simon gets to hold those shares. So the way it works is this. So the shares, as I mentioned earlier, are issued at the point of the handshake. There is then the delivery horizon and an assessment at the point at which you're evaluating whether Simon did what was agreed. If the answer is yes, press a few buttons and the shares come out, and Simon has them as if he held them from day one. If, however, Simon only did some of the work that was promised, or indeed did none of the work that he was promised, then Stephanie can convert those shares, either some of them or all of them, to deferred shares and then cancel them. So Simon will never walk away with any shares that he didn't truly earn. But if he has earned them, he'll have them and he'll benefit from them as if he had them from day one. Okay, so the two concepts we've talked about are growth share and then conditional shares. And we use these in many ways, but one of the ways that we use them is known as an agile partnership, which is very relevant for early stage businesses, especially amongst friends, as you'll see in a moment. So let's start with another little scenario. So Arthur, Sue, and Jazz set up a business together. Everybody's going to make the same level of contribution to this business. So everybody's going to get a third of the business each. So 10,000 shares each are issued, 30,000 in total. Okay. But then over time, or who knows what time horizon takes place, but it becomes clear that different people are delivering at different levels. So everybody needs to get clear on what each person has to bring to the game. Okay. So they understand that Arthur's going to deliver X, and for that, they'll issue another number of conditional shares. So his additional potential reward here is another 30,000 shares. Okay. Susan's going to deliver Y, and Jazz said, and actually now there's a new person, Ella, who's come to the table as well, and she's going to deliver A. So what's happened here is, in addition to the original 30,000 shares that were issued when they set up the business, they've now got another 120,000 shares issued based on very specific deliverables. Now, so long as those deliverables, X, Y, Z, A, whatever they are tangible, measurable, and specific, this makes life really, really easy. Okay, and that specificity can be as simple as time horizon. So X could equal, you stay with the business and work full time for the next year or 2 years, or X could be something as straightforward as monthly qualified leads or a sales target. And obviously, given that this is all going to be very straightforward, simple maths, you can create sub milestones as well. So X could actually equate to X1 plus X2 plus X3. So you can make this as straightforward and simple, or as complicated and layered as you wish. But so long as you maintain that important point that I mentioned earlier, which is about making sure it's tangible, measurable, and specific, then when it comes to the assessment of who actually delivered what, it becomes very straightforward. So Arthur delivered 95% of X. He holds on to 28,500 of those conditional shares and now still holds a third of the business. Whereas the other interesting one here, Jazz, who only delivered 25% of Z, will only hold on to a quarter of the conditional shares, and his proportion of the business has come down. But Ella, who came along, delivered 90% of A, has now created a material stake in the enterprise, which is far more equitable. Because clearly, in a scenario where Jazz still held a third of the business, Ella had not too much in the business at all. That inequity creates a lot of friction in early stage businesses, and that's at best. Worst case scenario is that a brilliant business proposition just goes nowhere, and the founders fall out, and that great idea that the world could have benefited from disappears. So what we've got here is a flexible way, certainly in those early days of setting up a business when nobody knows what's actually going to be delivered, or whether everybody's going to stay the course or stay fully committed to the journey. This mechanism is a very, very simple way of making sure that wherever you end up is fair and square in terms of how the business grows. We've been working a lot with, I don't know if many of you will be familiar with Slicing Pie by Mike Moyer. So Mike's actually written a whole chapter and a special edition of the book on how you can use vested to slice pie. And one of the things that we're offering for the folk here today is actually the ability to start, launch, and actually maintain your Agile partnership through vested for the first year at a massive discount. Basically, £25. You can incorporate your business, create those Agile partnership agreements between your partners in the venture, and we'll be giving that to the first 20 who register from the Edventure Emerge. That's the end of the talking piece of the presentation. Certainly open to questions now. I'll leave the slides up for a moment, but we can kill that if required. In fact, why don't we?
Yeah,
I'll leave that on for now, and let's take it from there. Go on, Ragnar.
Yeah, thank you, Ifty. That was really insightful. We have a couple of questions. I will start with the one below here. How do you deal with the difficulty of quantifying a contribution when it comes to these agreements?
So the first thing, it's actually not that complicated. We have a number of examples of how that distribution can be made. The most simple one is just around time. But whenever you start a business, each of the parties in that business, you have to know what one of those is going to bring to the table. It's even if those questions are difficult, or even if you can't decide, is it going to be around the amount of time I bring to the table? Is it going to be around the sales or the investment rounds I get? Whatever it is, it's better that you have that conversation at the early stage and amend as you go along, rather than not have that conversation, because sooner or later somebody is going to deliver what you thought they were going to deliver, and others are not going to bring to the table what you thought or what was promised. So in any case, however rudimentary that initial Agile partnership is, but to have talked through what you think each person is going to bring to the party is important. But certainly once you're into the conversation, we can certainly help you with examples of ways in which to quantify things.
Yeah, but for example, when it comes to code, the metrics, they are like lines of code or hours worked is often diverge very much between developers and the quality of them. Then if the code in the end actually is really maintainable or is performant, then not always kind of quantifiable metrics there.
Whatever you would have determined, let's say if you're going to pay somebody cash for doing something, whatever you would have decided that's what that cash would have been based against, you use that same metric. Whether the thing has been delivered, whatever it is, whether it's code or building an app or whatever, however you would have described the success of that, you can convert into equity. It's just like thinking about cash. But what we've made is we've turned the shares into essentially a currency.
Yeah, it's great to think about that like that. We have another question on your founding journey at Vested and what surprised you most.
The founding journey at Vested, let me take it to the start. So I started my life in the oil industry, and quarter of a century there, very successful career. But I've spent so much time traveling and stuff. My mum and dad passed away, and I just decided to change life. I had enough money. I'd tried life as an entrepreneur just straight out of university. I had this idea. I'd taken it to the whole enterprise council, and they didn't have a clue what I was doing or what I had in mind. And I had the idea was this database with terminals that you could see houses in different cities. If you went to an estate agent that had a terminal, I think today you'll think of it as Zoopla or Rightmove. But anyway, that was all history. I couldn't get any support, so I thought, well, I've already got this job with BP. I'll join BP, and a couple of years down the road, I'll just do it myself. I don't need anybody else's cash. Well, it took me a long time to get to that stage of coming back into the true entrepreneurial space. And what I'd originally decided to do was take a chunk of cash that I'd had, a couple of £1 million, and what I'd do is help early stage businesses with that cash to try and help those Ifties that were out there today. But alongside that, what I wanted to do is see if we could actually build a business of our own and learn from that, so that the learnings could actually make some of that money that we were deploying wasn't just a punt. It was actually something that we could learn and understand about. The challenge was I'd put £250,000 to the side to build this business and thought that a year or two would be enough. The fact is I've put probably 10 times as much money in, but we've built something that now has thousands of people using it, so far more people than I could ever have helped directly. But it was at that stage, at about a year and a half into the game, I decided rather than just spreading out money against 10, 20 startups, there was more than enough money out there. So what I decided for us to do is to focus in on the equity side of it, making equity a usable tool, a safe tool that wasn't complicated, wasn't expensive, but allowed founders to get everybody who's part of the game vested in it, real skin in the game. And so my own founder's journey was, we started it off as an experiment that I thought was going to be very easy and very quick, learnt lots, but then decided to carry it on as a venture. And as I say, now we help thousands of businesses, from issuing EMIs to their employees through to options, growth shares, and just managing their equity in totality from start to finish, whether it's issuing shares on an investment round through to rewarding advisors or whatever. Everything to do with your equity can be managed through the platform, but it takes away all the costs and complexity.
Definitely a very powerful tool, especially at the early stage when founders don't really have any other resources or assets to give out, to have people contribute to their mission.
That's right. And lots of people will promise, Ragnar, they'll promise all sorts of stuff. And founder may well in good faith issue the shares at that point, but then they don't deliver. And then they can't chase them because they don't have the resources to go chase these people. And on the other side, if you as an early stage founder were promising somebody some shares if they did X, how do they know that they're going to get their shares? So many founders, this trust thing applicable on both sides. There are founders out there who don't honor their word, just as there are contributors or team members who don't deliver their word. What you need is a mechanism that allows you to use your equity in good faith on both sides, but safeguards both sides as well.
Yeah, and on that note, someone actually asked, what do you do if the founders or you can't agree on the equity or on the contribution that each person has done?
So that's absolutely the core point. If you do not have these conversations up front and set, this is the basis for what you're going to get these shares, leaving that conversation a year down the line or 2 years down the line, when people on the notion, whatever the agreement that you have today, If you can even enshrine that and then have another understanding 6 months down the line. But what you're doing is you're not locking everybody in to a certain outcome of the business, irrespective if they decide to do part-time here and go do something else, or not really deliver what they said they were going to do. What this allows, firstly, you'll never end up in a situation where that adjustment is going to feel happy for whoever it is. But what you're doing is you're reducing the risk of a totally inequitable outcome, where the friction between the founders, as I say, will create really bad blood when somebody's getting something for nothing and somebody else is busting a gut. You'll see that quite easily. So the challenge is, at some stage or another, you will have to have the conversation. Better you have as much of it as you can up front, and then because of the Agile partnership having such a structure that you can then have another conversation 3 months down the line, 6 months down the line, a year down the line, whatever stage you are, it allows you to keep that fairness in the enterprise and allows the enterprise to stay alive.
Thank you, Ifty. That was super insightful. Session has come to an end, unfortunately, but I think the audience learned a lot from this workshop.
I hope so, and just remind everybody that for the event, we've given a discounted participation on Vested.